to the position too early. I think that's the biggest problem. So let's dive into this for a moment. So what I mean by that is, here is a little diagram that I quickly drew out of the strategy that I teach. Now, I'm just going to quickly run through something very specific. You get various types of traders. You get, you get breakout traders, you get support and resistance traders, you get trend line traders, and funny is all of that perfectly lines up with all the strategies, all amalgamate into one specific thing. The problem, though, is that is what the market is designed to do. It paints a specific picture, and the moment that picture is painted and most traders enter, that's when the market flips. It takes you out, it grabs the liquidity, and then it actually goes in the intended direction. So what I mean by that is, here you will see, this is a break of structure. So I've earlier this morning, I posted a educational video to the premium guys to explain supply and demand. So I explained a little bit of why certain traders get in at certain points, inducement, liquidity. We'll run through all of this quickly, but I just want to just briefly paint a little bit of a picture for you guys. When we have a break of structure, breakout traders would enter at this point. So the moment this high breaks and price breaks through this high, breakout traders would enter here. Okay, they'll place their stop losses below this low, they'll enter the trade over there. Price will push up. Great. It will then return. So this would have swept some sort of liquidity to the left. Price will then return. Break and retest traders then jump in at this point. Why? Because it's retesting the initial break point. It's retesting support. So two types of traders will jump in. Now we're already at three. First, breakout. Second, break and retest. Third, support. So support and resistance traders. Now suddenly, do you see we've got three groups of trading strategies that's now aligned into one specific thing that is all now jumped into this trade here. Stop losses all resting above there. The moment this breaks that high, all these stop losses now move to this point. All those stop losses now move to this specific point. So hopefully, if you use a little bit of savvy, you'll now understand what, when we talk about liquidity, look at that. Stop losses have all moved from that level to that level now. Most traders took additional positions in this break up. So a lot of them have added more positions in this leg up. Price then has generated enough liquidity to fuel its next move. But my trading strategy does not allow me to enter the trade on these types of setups, because now we've got trend line traders that are in there. We've got these support and resistance traders that are in there. Okay, you guys see that? It's clear as day. You can't miss it. Now comes the real move, the real manipulation. Price then just dumps to the downside very aggressively and very quickly. So all the traders that added positions in here are suddenly drawdown. All of them are suddenly in the trouble. Okay, they really nipping, because now like, what the hell happened? Price then takes all these stop losses out. It grabs all the liquidity it needs. Sometimes it even pushes a little bit lower. If this is not enough, it will push a little bit lower. It will just take out this low and then rectify and then push up. Then the real move goes without you. Now, how many of you has that happened to, where the moment you jump into a trade, the moment you see, okay, it's going my way, it suddenly flips, deep dives into your stop loss, and then actually goes where you thought it was going to go? It's the trap. That is the market manipulation. That's what we all talk about. It's liquidity. So you need, yes, Ian, not anymore, because you've learned this. You've learned the 6 steps. You've learned the skill, you've learned the setup. So when you are impatient, when you are new, when you always get this FOMO, this fear of, oh shit, this is going, especially if price breaks the second high and you didn't enter at the low, most of the guys would then jump into a trade at this level. Anything between there and there is where they would then try and jump into the trade. Price then rips to the downside, takes out the low, takes out the second low potentially, takes out everyone in this move, and then pushes up. So I've come up with a trading method called the 6-step strategy. Super simple. It is literally as simple as day. You cannot get involved in the trade until you get the liquidity sweep. So if price keeps making higher highs, higher lows, you sit back. You do nothing until you see that aggressive move down. Once you see the aggressive move down and you see liquidity being taken, now only we get interested. Now only we come to the party to play. Okay? Think about, remember this. If you cannot spot the liquidity sweep, if you can't physically see the liquidity sweep, you will become the liquidity sweep. It's as simple as that, because you will enter and you will place your stop loss on the most obvious place that the market will come and attack. That's it, guys. That's as simple as it is. And this is the strategy. We then wait for price to return to sweep. So in theory, this is what we do. This is called our 6-step. 1, 2, 3, 4, 5. This is our 6th level. This is our entry point. This is where we get involved in the trade, and we take the trade all the way up. All the way up. Our initial target is obviously structure. This 99.9% of the time will deliver a 1 to 2R, if not more. The moment price breaks there, we normally get a good runner where we get 2R, 4R out of the trade. And this is our 6-step strategy, guys. It's simple. Number 1, it's going to keep you out of bad trades. Number 2, it's going to keep you out of the trade when it's not ready to trade. And number 4, if you do take a loss, it's so small that we then just jump into the trade again once we spot it. Because like I say, sometimes price will just take the low. So if you execute again too early, it comes down to patience. If we don't get the confirmation and you enter too early, price could literally just take you out and then actually go in your favor. So it's always important to, number 1, wait, get your timing correct. Number 2, get some sort of confirmation in this level to actually execute the trade. So in our VIP, we teach this in a little bit more detail, but I'm not going to gatekeep today. I'm going to show you guys what we do and how we do it. It's as simple as that. Yes, the entry model, this specific model that we wait for to enter from, is something we teach in VIP, because then it dives down to confirmations. It dives down to candlestick anatomy. It dives down to what engulfings are, what supply and demand is, all these other things. I think there's more people. Yeah, I said I wasn't going to admit more, but okay, last one. Okay, so sorry, whoever just joined, you've obviously missed a little bit already, but yeah, so just the video is recorded so you guys can catch up. Okay, so the entry model is what we then teach a little bit more refined and in detail in the VIP and on mentorship. But the strategy is the same, guys. I'm not gatekeeping anything, not taking anything away and holding something back and saying, no, you got to pay for it. I'm giving you the information completely free. Okay, all I want you to do is be part of my community. Be part of what we're trying to build and spread the word. That's it. Okay, so this is a very simple diagram of what a clean structure, clean movements look like. Price doesn't look that way. It's always a little bit more messy. So this is what it would potentially look like. And this is what I mean with confirmation. Once we get confirmation, fail to make a new low, a new high is created, this is where we get involved and we jump into the trade. This is our confirmation. But the strategy is still the same. There's our 1, 2, 3, 4, 5. This is our 6. Our 6 is below liquidity. We wait for liquidity to be taken. We wait for our confirmation. We jump into the trade, we trade. As simple as that. Our stop loss would literally be below that low. This would be stop loss. And I'm saying as simple as that because, guys, it is literally this simple. Our 6-step strategy teaches you everything you need to know. Okay, so important things that we need to look at to determine which direction we want to trade is just a short-term bias. We don't have to do top-down. I don't care what's really happening in the daily, weekly, monthly, yearly, all of that. I just want to be in and out of the trade in the next 5 to 10 to 15 minutes. That's it. I just want a short piece of the pie 2 to 3 times a day. That's it. Over trading will totally kill you if you are executing more than 4 to 5 positions a day. Meaning, if you open up your trade history and there's more than 4 to 5 positions a day, you're over trading. You're over trading. How many times have you made good profit and then end up losing everything and more at the end of the day? Why? Because you're over trading. Every single time you push that button to execute a trade, you are opening the door for the market to come and take money from you. So why, when you've not made money, close that door, lock it, come back the next day? That way, tomorrow, you're waking up with a stronger balance. You've made profit, plus for your psychology, for your mental state, it does wonders. Even if it's $5, $10, $6, however, it doesn't matter how much you've made. But if you've made profit for the day and you are happy, wake up the next day, come back, we do it again. Because, guys, I'm telling you, coming back the next day, you come back with a different mentality. And the more you are okay with making a little bit each day, at the end of the month, before you know it, you have made good freaking money. I just want to, before I carry on this, I just want to show you guys something simple. Just to think about. The average salary in South Africa for an average job, and I'm not talking about high-end positions, I'm talking about the average, is about 25,000 Rand per month, right? 25,000 Rand per month. Now, question, how many hours a month? James, one thing I've learned is chase the setup, not the money. Correct. Correct. If you wait for the setup, the money will come. Don't focus on the money. I just want to explain something. So the average salary in South Africa for an average job is 25,000 Rand per month. Now, how many hours a month do you have to work to earn 25,000 Rand? So an average person works 8 hours a day times 5 days a week times 4 weeks is 160 hours. So 25,000 Rand divided by 160 hours is they make 156 Rand per hour. So divide that by 16 in dollars is they're making $9.7 an hour. Okay, they're working 160 hours a month to earn $9.70 an hour. But you guys want to come on here and smack $50 to $100 to $200 in an hour. Make that make sense. That math is not mathing. Guys, if you are literally making $10 an hour, you are earning more than the average South African. This is our problem. We all come to this platform, we all come to trading saying, if I just make $100 a day and you give yourself this high target, $100 a day, $200 a day, I can quit my job and I can live comfortably and I can buy my dream car. That's the wrong way of thinking. Work it backwards. What are you currently in your current job getting paid per hour? How much do you have to do to earn that per hour? Then figure out what you need to do to make that in trading per hour, because guess what? Just that alone will change your life. Just that alone will give you financial freedom. Okay, so that was my way of thinking about it and approaching the market, which changed my trading for me completely, because I stopped focusing on the money, and all I said to myself is one good trade a day will give me what I need at the end of the month. So all I was looking for is to take one good trade a day. That's it. Okay, so let's carry on. So just think about it. That's quite interesting just to see it from that perspective. Okay, so short-term bias. What do we want to see in a short-term bias? Are we creating higher highs? Are we breaking to the upside? Or are we breaking to the downside? If we are potentially breaking to the downside, we've got to wait for two things. We either need to wait for a change of character or a reversal to the upside to then trade the upside, or wait for liquidity sweep to then take the next leg down. Simple. Same this side. We have to wait for the liquidity sweep or the reversal to either trade the reversal or in the continued direction. So it doesn't necessarily mean we need to constantly look at higher time frames, but you as new traders cannot look at smaller time frames than what I've got here. If you are working and you've got a busy day and you can't really watch the charts and monitor the charts all day, then 30-minute to 15-minute. You get your zones on the 30-minute, your entries on the 15-minute. If you've got a little bit more time during the day and you every so often look at the charts and it's open up inside of you, 15-minute to 5-minute entry. 15-minute zones, a reaction out of 15-minute zone, 5-minute entry. I'll explain that. We'll give you guys an example. But just a short-term bias, because remember, we're just trying to catch a trade within that first hour, hour and a half of every session. So when we come to the chart, London Open, within that first hour, hour and a half, I just try and catch one trade. US AM session, I just try and catch one trade. US PM session, maybe just one. That's 3 trades a day, more than enough. A for a way. I'm earning way more than that potentially, and off we go. Okay. The next thing that we need to identify is our liquidity. Now, what is our liquidity? Our liquidity rests at lows, and our liquidity rests at highs. And as I've explained it in this scenario, is the moment price breaks this level, this first level here breaks, traders have entered all up in this leg. Traders have started to get into the trade. Breakout traders got in. Support and resistance traders got in. All of them engulfing whatever strategy, all of them started to get into this leg. So stop losses are resting at the lows. The moment price breaks that second high, what do traders do? They move the stop losses to either break even or into profit. Okay, next structural point. That's standard practice in trading. We do that. We manage risk. It's not a bad thing. It's a good thing. But when you do it too early, too prematurely, you get taken out on break even and you miss the move. They then have to enter again potentially. Price then does something like that again and then only actually goes in its favor. So they then get taken out again. More liquidity is created and off price goes. So remember, highs and lows, liquidity. Stop losses, new pending orders, whatever the case is, it's liquidity. That's how we address it. We speak of it. Once we've got our liquidity, we need to ask ourselves, do we have the sweep yet? No liquidity sweep or no liquidity being generated. If price just does this and there's no liquidity in that leg, we can't trade it. Because how do we know where price will actually turn or reverse from? The biggest mistake most traders make is they try and predict and guess the market. They see levels of other structure to the left. And when price gets there and just slightly reacts, they sell. Price then reacts and then pushes through. More liquidity is just fueled in this move. It's just grabbing more and it will continue to go and go and go until there's no more liquidity to the upside. Then only we'll start seeing that trickle down reaction, move up. It will do something like that, sell off from this area again. Now we've got new liquidity, price comes down, takes all of it out, and then pushes back up, vice versa. So liquidity is so extremely important. If we don't have any liquidity, we can't trade. Okay, so let's say we do have liquidity. We do spot the liquidity sweep. Then it's simple. We need to identify a zone below liquidity to actually look at and potentially trade from. So how do we do that? We go back to this level. The moment price breaks that structure at this level, the moment price breaks there, we get that breaking point. This gives us a BOS, a break of structure. Now, any random indicator that you use will actually it will actually draw it for you on the chart. So I want to use this one, just an example, a real actual chart example. So here you guys can see we've got a break of structure there. We've got liquidity. So there's our 1, there's our 2, there's our 3, 4, and there's our 5 leg. Our 4 is our liquidity. You see how price beautifully came back aggressively, tapped into our zone, and then sold off again. It's not a coincidence. This is how the market operates. So I always, between my 1 and my 2 level, draw a box. Then I draw another box on the top half. That is my area of interest. That is where I want to look for my trade. I want a reaction out of this level. If price closes above this 50%, I know the potential that it will sweep the high, and I only will be interested in trade once it closes below this 50% again. So if we get something like this, I will only be interested when it closes below that 50 again. Now we'll start watching to see what it does. So quite simple. This is our confirmation that we've got a reaction, but this zone is where we would potentially want to trade from. It doesn't mean we just jump into the trade when price gets there, but look how aggressively this was an opening candle. This is literally the market closed there and it opened in that area and immediately reacted and sold off. It happened so quickly that 89% of our trades immediately goes into profit. Guys, it's insane. Immediately runs into profit. We can go stop loss break even and it runs and we make decent money very quickly. This trade literally takes 15 to 20 minutes and you're done. You out. You klar. You're done for the day. So let's look at another example. Same thing. There's our 1, 2, 3, 4, and our 5. Look at our 4 level. 4 level is always liquidity. What did price do at this level? Literally came back, took the liquidity, sold off. Where's our target? Our most recent low. Because we're following trend, price should make a lower low. So simple. That's our trade. So look at this example again. From 1 to 2, we draw a box. Price didn't come in deep enough, but look how beautifully it swept the liquidity and it started selling off. By the time it broke the structure, we knew it would not come all the way back. So at this level is where you would potentially jump into the trade there. And it brings you down. Your stop loss would be above that level. Okay, so it doesn't always come deep. Sometimes it's very shallow, very aggressively. This is Bitcoin though, because this is the only market that's currently open. So it's easy for me just to show you guys most recent price structure. I was hoping to get some bullish formations. There is actually one. Here we go. Bullish one as well. There's our 1, 2, 3, 4. There's our 5. There's our liquidity sweep right there. Bam. Look at this. If I draw my block from high to low, and I draw my block from second half, there's our entry, guys. Right smack bang there. It will react from here. It should come and sweep this liquidity. It should at least push up. Okay, so very simple. We wait for our liquidity sweep. Once we get our liquidity sweep, we have identified a zone below liquidity that we potentially want to trade from and see price react from. Once price reacts from a POI, so what is a POI? POI, we would potentially look at this deepest fair value gap is an area of interest. There's another fair value gap there. We also get something called supply and demand, which is our bottom zones. Supply and demand is created when price breaks structure, it leaves behind an area of supply or demand. So which one is supply? Which one is demand? Simple. Think about it this way. When price takes off, there is demand for the product. Buyers have taken interest in something, they've demanded it, they've purchased it, they've bought it, off price goes. So my back. Can you guys hear me? Okay, sorry. Battery died. Sorry, guys. Apologies. Okay, so remember an area of demand is at the lows. And once we've had an area of demand and price is pushed up, eventually buyers will get exhausted. Buyers would not be interested to keep paying more and more and more and more for a product. Then there's an oversupply of a specific product. Then they are looking at either giving it back to the market, selling it back, or sellers will then step in and say, okay, thank you, we will take your supply. So demand at the bottom, supply at the top. But my terms, SND. This is a SND, supply and demand area. At the top, SND, simple. So I don't like to specifically demand supply. It's simple. SND below, SND above. Okay, we also have something called base. Now this is where the magic happens, is a base. How a base works is as follow. You have an aggressive push up. You have 1 or 2 down close candles and then an aggressive push up again. This has now left a base for you below. This area right here is now a base. So what price will love to do is it will then create liquidity in this area. It will then sweep the liquidity, react off of the base, and then continue in the intended direction. The base is then your higher time frame liquidity. That price will eventually return to sweep and then continue in the intended direction. Once you are able to spot this, so let's look if we can see a base. Let's see if we can see a strong base. Here we go. This would be a base. This would be a base. On a higher time frame, let's just go 10 minutes. This would be a base. This would be a good example of a base over here. So price will rally, base, and then continue to rally again. I'll have a look now, guys. So this is our base. Price will return to this level eventually and then react from it. It hasn't yet. No, it hasn't. Oh yeah, look at this. Look at this. Look how beautiful. There we go. What did I just say? Where's our entry? Right over there. Look at that aggressive, beautiful push. Live, on stream, no bullshit, no lies. You can't say I planned it. There it is. Just shows you how powerful this setup is. What we are doing and what we are teaching you guys will make you endless amounts of money if you just learn it, apply it with rules and structure. That's all you've got to do, guys. This changed my life completely. It's insane. Okay, so again, let's just go back to the bases. Rally, base, rally. We've got an aggressive push up. We've got one or two down close candles, and we've got aggressive push up. We've then left a base behind. Another one is a rally, base, drop. We've now left a strong area behind. The other one is drop, base, and rally. We've left a strong area behind. So this, others know this as consolidation. Same thing. Consolidation area, base, same thing. Let's look at an example. Base, consolidation, same thing. Price aggressively pushed away. This is a nice little base area that price would potentially have reacted from. Base on a smaller time frame, price will react and then push through. Same here. Look at this. This is a perfect example here. Look at this base that was created here. Look at how price stalled at the base and then rallied in the opposite direction and then continued. This is areas where you now know you can potentially get involved in the trade. So what I would personally do in this specific area, if I know, here's my 6-step for liquidity. Here's my higher time frame area that I know price will potentially target back to. I will take a buy position out of this area with a stop loss at this low into my liquidity. So it's the 6-step has now given me 2 trade opportunities into my liquidity and away after my liquidity sweep in the ultimate direction. That means 1 setup, 2 trades, done for the day. Simple. You can't rush this. You've got to wait for a very specific thing to happen. This sort of structure. What we teach in VIP is entry model, how to get involved here and when to get involved and when not to. Because if you tried it here, it would have failed. If you tried it here, it would have failed. So you've got to be very certain and wait for specific criteria. But look at this. Another 6-step there. 1, 2, 3, 4, and 5. What's below there? Our liquidity. What happened? Price returned, then traded away from it. What's our target? Just these highs. Just to trade from there to there. Good enough. Simple. I'm not making this stuff up, guys. It's literally as simple as that. So we've covered SNDs. Supply and demand. How is supply and demand created? Simple. When price pushes up, pulls back, pushes through. The last Sunday, we spoke about ICC. Intent, correction, continuation. Same model. Do you see how all of this starts to fit into each other? We've got intent, we've got correction, we've got continuation. Once we have continuation, we are left with an area of demand below. Why? Because price aggressively pushed away, broke structure. We then want price to return, sweep our liquidity, and react off of our demand up. So we already know what we want to happen. We already know where we want it to happen from. We just need the patience to wait for this to happen. Once this happens, simple, jump into the trade, stop loss at the low, and we try it. With this type of risk to reward, think about this. For example, if you take a trade like this and you've got a 2.9R, let's call it a 3R trade. Let's look at probabilities here for a moment. If you are risking $50 to make 100 slash 150, because a 2R will give you 100, a 3R will give you 150. Now, if you are risking and you are trading, come on. What am I doing wrong here? Why is it not duplicating? Okay. Any case, if you are, let me just use the pencil. If you are taking 5 trades, 1 trade a day, 5 trades a week, and you're risking 50 to make 100 to 150, and you take 3 losses back to back, 50 lost, 50 lost, 50 lost. You've totaled down 150, right? 1 trade. One W, you are back at break even. Your second W, you are in profit for the week. 5 trades, 3 losses, 2 wins, you walk away with $150 profit. Now, if you're taking a trade of this, your chances of success are much higher than this. What would this be? 3 losses, 2 wins. This would be a 30% win rate, if I'm not mistaken, 40% win rate. If you're taking trades like this and you're waiting for liquidity to be swept, you're waiting for it to trade out of a zone, your win rate will increase. That means you'll have 3 wins, 2 losses, potentially. Then we walk away 150, 150, 3 wins, 2 losses potentially. 100 down, you are still deep, deep, deep blue. You are then still earning way more than the average South African 25K a month extra paycheck to do whatever you want to do. Okay, when we are just waiting for these type of setups with the patience and take these type of trades, our win rate drastically increase. Plus, a lot of the time, because we are trading in the actual trend direction, higher time frame bias direction, this trade potentially runs sometimes to 1,000 pips, for instance. We then move stop loss into trail it, and we are making potentially 250 on this trade instead of our 150. We'll always try and make more, but never lose more. Never, ever, ever do we move a stop loss or try and lose more. That's the biggest mistake that most traders make. They see the trade going against them, then they move the stop loss. Deeper drawdown, move the stop loss. Deeper drawdown, move the stop loss before they know it, the account's gone. Boom. Instead of just walking away with the $50 loss of whatever you were risking and trying another trade later, you have just blown your account. Or you've lost half of your account, or you've lost your entire week's profits. That's the biggest mistake. We never, when we trade a system and there's structure, there's rules, there's our stop loss, there's our entry, there's our take profit. That's it. That's structure. It's a rule. We just do the same thing over and over no matter what happens. And we let probabilities play out. It's as simple as that. Okay, so we've basically looked at covering everything. We've got our POIs, we've got our SNDs, everyone knows what a fair value gap is, I hope. Is there anyone that doesn't know what a fair value gap is? Anyone? Just drop it in the chat quick. Anyone? Okay, I'm not seeing any chats pop up, so I'm assuming everyone knows what a fair value gap is, right? Great. So then, all we wait for is a shift in structure to confirm our move and get into our trade. What does that shifting structure actually look like? Let's see if we can see something, see an example here. There we go. So look at this, for example. A shifting structure would be when when you fail to make a 5-minute bull close. Yes and no. 5-minute bull close isn't necessarily a shifting structure yet. A 5-minute bull close is potentially just a confirmation that price is shifting, but not a confirmation that it's shifted. So, good confirmation that price is shifting is when lows are higher than the previous low and new highs are being created, meaning price is lows. You are failing to create new low and a new high is created. Or you have a liquidity sweep with a new high being created. Once you have a structure like this, I love this. This is my favorite structure. When I have a low taken, an aggressive correction, and a high being swept or a high being broken. That, for me, is confirmation. The moment we then have that return to either a base, SND, fair value gap, anything that we have in this area, I'm in that trade. Every day, any day, all day. If I have a fair value gap here, if I have a demand zone here, if I have a base, so price will react off of here and then push through. This would be a base. Any area, any POI I have in this specific relative area, I'm in that trade with my stop loss below that low. Done. Targeting liquidity, targeting highs, whatever. That's it. This is trading 101 in a nutshell, guys. All we've got to do is literally be patient enough to wait for the trade from your area and give you the confirmations and to your targets. That's it. That is literally as simple as it is. So I don't know if there's any questions. I think let's just open it up quick 5 minutes just for quick Q&A. If there's any questions, then let me just so what I can do is just open it up for 5 minutes. Any questions, guys? I'm just trying to look for this damn chat. Where's our chat? Oh, where's our chat? Hey, Eugene, I see a raised hand. Did you have a question or was it? Okay, Shahi generally occurs after liquidity swept, correct? Okay, guys, 5-minute Q&A. Any questions? Anything that you guys want to know about this specifically? Going once, going twice. Come on, surely there's got to be something. Surely there's some questions. Whoever is not in our premium signal group yet, please, I want you guys just to open up a Prime Trading account, deposit a little bit of bucks in there. You get free access. Prime pays for your membership. And I don't just say buy now, sell now, guys. This is not what I do. I teach this. I share my chart. I share my setups. I give you everything that I look for. So I really drop value. You're not going to find another group like this anywhere else. Where do you know where to start with number one? Your first BOS, your first break of structure in any direction is your one. Revisit how to identify the base. The base is any down candle in an aggressive up move or any up candle in an aggressive down move. So it's difficult. You can't really identify. You will see it. Any aggressive move in a specific direction will have one or two opposite closing candles in that aggressive leg. Sorry, Michael, do you consider fair value gap only if it's 3 bullish bullish slash bearish candles, or can there be two bearish and one bullish? A fair value gap's a fair value gap. You just need to make sure if the fair value gap is within your zone to trade from or not. You explain everything well, so it does not leave questions. Great, Niels, thank you. Just answered my question, thanks. So basically an order block. Yes, better known as an order block, but we call it a base. Most people, because you get order block, you get breaker block, you get all of this. It gets too confusing to identify what is what. I try and dumb it down and simplify it to the guys. It's a base. Simple. Our terminology is a base. But yeah, I mean, all these ICT, MCT, I don't know what all, they all got their own fancy terminology for a bunch of shit. It actually all just comes down to the same stuff. Any more questions, guys? Okay. Well, that's it. Hope you guys enjoyed. Thank you. Thank you. Thank you. Thank you. What I'm going to do is I'm just going to drop. So Caden, I don't know if everyone has seen Caden posting in the group. Caden is my assistant. He's helping me get everything set up. I'm getting quite busy with my mentorships, with my trading, with my own personal things as well. Plus, I'm getting very tied down in terms of time. So I'm just going to, in the chat here and in WhatsApp, just drop Caden's details plus the links. If you guys are interested in getting involved with us, interested in joining, interested to know a little bit more about VIP, mentorship, anything, 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 reach out either to me or to Caden, and we can definitely get you guys set up. And yeah, guys, this is it. Trading is not that hard if you just dumb it down and stick to the basics. Simple. Okay. So if you guys don't have any more questions, I hope you have a beautiful, beautiful Sunday evening. Go spend some time with the family, and then we kill these markets tomorrow morning again. All right. Hope everyone has an awesome Sunday. Ciao, guys. Ciao, legends. I'll see you on the profit side, eh? Hope everyone. Okay. Ciao, boys.